All right, quick favor before we dive in. If you care about understanding markets instead of just reacting to headlines, you're in the right place because something just snapped. In less than 24 hours, silver fell roughly 21.5%. We're talking a drop from about 120 an ounce down to the high 90s. That move alone vaporized around $1.4 trillion in paper value overnight while you were sleeping. And here's the part that should stop your scroll. Physical prices in China barely flinched. Both major futures desks and physical dealers confirmed the same thing at the same time. This wasn't demand disappearing. This was structure breaking. Stay with me because I'm going to show you what actually happened, why it matters right now, and how you can spot this setup before the crowd next time. Before I explain what caused this, let me teach you something most people never really internalize about markets. You don't trade silver, you trade layers, you trade paper contracts stacked on top of physical metal. You trade leverage sitting on top of leverage. Think of it like a high rise built on borrowed beams. When conditions are calm, it looks solid. When stress hits, the weakest layer gives way first. Most people think price equals value, but price is often just the last transaction between leveraged players. It's noise on top of signal. When you understand that, you stop asking, why did silver crash? And you start asking, which layer broke? And once you start thinking that way, you see these moves coming instead of being shocked by them. Haven't you noticed how the biggest moves always feel sudden to people who weren't watching structure? If this is making sense so far, drop a comment and let me know you're following along. I want to make sure this lands. So, what does that tell us? It tells us that when you see a massive price move in one market, futures, but the physical market stays firm, you're not looking at a change in fundamental value. You're looking at a structural event, a forced liquidation, a margin call cascade, the paper market breaking under its own weight while the real asset underneath stays relatively stable. That gap between paper and physical, that's your signal. That's what separates people who panic from people who prepare. Now here's what's actually happening. Let me break down the sequence the way it really unfolds. Silver had gone parabolic. You saw it. You felt it. You probably even heard people saying this time is different. Everyone's a genius in a straight line move, right? Leverage piled in fast. Futures positions expanded. Margins tightened quietly in the background. Nobody notices that part. Liquidity thinned as price stretched higher. That's the setup. That's the trap being built in real time. Then the trigger hits. Price wobbles just enough to stress margin requirements. Could be a headline. Could be a big seller. Doesn't really matter. Some players can't post collateral. Maybe they thought they had more time. Maybe they overestimated their cushion. Either way, forced selling begins. Not selling because they want out, but because they have to get out. That's the critical distinction. That selling pushes price lower, which hits more margins, which forces more selling. It's a cascade, a domino line built from leverage. And here's what makes it so violent. Each wave of selling creates the next wave. It's mechanical, programmatic even. No emotion required, just math hitting reality. Here's what's wild. None of that requires a single ounce of physical metal to change hands. Zero. You can have billions in paper value evaporate while physical inventories sit exactly where they were yesterday. And that's why you saw futures prices implode while physical premiums stayed elevated. The paper market was liquidating itself. The physical market? It shrugged. But here's the part that should make you nervous if you don't understand it, and confident if you do. This kind of selling ends when sellers are exhausted, not when fear peaks. Let me say that again. Forced liquidation ends when there's nobody left to force out. Not when the news gets scary. Not when your uncle calls asking if he should sell. When the math runs out of victims. That's when it stops. And usually, that happens faster than people expect. Because leverage unwinds are violent, but they're also finite. There's only so many people who borrowed too much. Now let me show you what very few people are talking about. While this was happening in futures, something else was happening in the physical market. Dealers in Shanghai reported premiums holding above spot. That means people were still willing to pay more than the official price to get actual metal in hand. In Singapore, same thing. Premiums didn't collapse. They compressed a bit, sure, but they didn't break. You know what that tells me? Real demand didn't vanish. Real supply didn't flood the market. This was purely a paper event, a leverage flush. And if you've been paying attention to market structure instead of just price, you saw this coming from a mile away. Zoom out for a second because this isn't new. This is the exact same playbook silver ran in 2008. Do you remember that? Silver went from $21 down to 8 in a matter of months. Everyone said it was over. The bull market was dead. Manipulation won. And then what happened? By 2011, silver hit $48. Same pattern in 2011 itself. Parabolic move, margin hikes, forced liquidation. Silver dropped from 49 to 26 in 5 days. 5 days. Headlines screamed about the end of precious metals. And then silver spent the next decade consolidating, building a base, setting up for the next move. Same again in March of 2020. You remember that, right? COVID panic. Everything sold off. Silver dropped from $18 to 12 in 2 weeks. People thought the world was ending. Physical premiums exploded to 30, 40, even 50% in some markets because you couldn't actually buy the metal. But futures? Futures were in free fall. Classic disconnect. And what happened next? Silver went to 29 by August. Every single time, you saw a violent paper flush, massive headline panic, and commentators declaring the trend dead. And every single time, once forced selling cleared, price stabilized, rebuilt, and then moved higher. When you look at the pattern, the common thread isn't manipulation or coincidence. It's leverage reaching an unstable point. It's the market getting too crowded on one side, too many speculators, not enough conviction holders. Zoom out, and you see that these crashes weren't endings, they were resets. They were the market shedding excess weight so it could move again. The larger story is that silver has always been structurally prone to this behavior because of how thin and leveraged its paper market is. Small market, big leverage, massive volatility. Does that sound familiar right now? Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep falling? Yes. Could sentiment stay ugly longer than you expect? Absolutely. Could we see $90? Could we see 80? It's possible. Markets don't owe you a bounce just because you think it's oversold. And here's the thing about manipulation claims. Sometimes they distract you from what actually matters. You don't need a villain to explain a leverage unwind. You don't need conspiracy theories to understand margin calls. You just need math. You need to understand how the plumbing works. Could there be players with agendas? Sure, there always are. But focusing on that keeps you from focusing on what you can actually use. Focus on what you can control. Watch price behavior, watch liquidity, watch whether physical markets confirm or diverge, watch open interest, watch volume. If those signals break, you adjust. If they don't, you don't panic. Simple. Not easy, but simple. The people who survive these events are the ones who have a process, not the ones who have the best story about who's pulling the strings. There are probably 3 types of people watching this right now. First, you're holding silver, and you're rattled. Maybe you bought in the hundreds, maybe you bought higher. You're watching your position bleed, and you're wondering if you made a massive mistake. That's normal. You're human. Money does that to us. For you, the question isn't what you feel, it's what the structure is telling you. Are physical dealers still buying? Are premiums collapsing or holding? Is this a demand problem or a leverage problem? If physical supply stays tight, if premiums stay elevated, this looks like a reset, not a failure. That doesn't mean it feels good. It just means the fundamentals might not have changed even though the price did. Second, you're on the sidelines thinking you missed it, and now you're wondering if this is a second chance or a trap. You watched it run from 70 to 120, and you thought you were too late. Now it's back in the 90s, and you're tempted, but you're also scared. For you, patience is power. You wait for stabilization, not headlines. You wait for volume to dry up. You wait for some sign that the forced sellers are gone. You don't try to catch a falling knife just because it fell a lot. Falling from 120 to 90 doesn't mean it can't fall to 80. Wait for confirmation. Wait for structure. Third, you're a trader who loves volatility but hates confusion. You don't care about narratives. You care about setups. You want to know where the liquidity pools are, where support might hold, where the risk-reward makes sense. For you, this is about levels and confirmation. No conviction without signals. No signals without structure. You're watching open interest. You're watching futures curves. You're looking at historical support zones. You're not married to a position. You're married to a process. And right now, your process is probably telling you to wait for the smoke to clear before you commit capital. No matter which one you are, the universal rule is the same. Markets punish emotion and reward preparation. The people who get destroyed in these moves are the ones who made decisions based on how they felt instead of what the data was telling them. Which one are you choosing? So here's what I want you to answer in the comments. Which category do you fall into? Are you holding and stressed, watching and waiting, or trading and hunting for setups? Let me know because I'm curious where you're at mentally with this. So here's where I stand. I'm not chasing, I'm not panicking, I'm watching. Let me tell you what I'm personally watching. First, I'm watching the 95 to $100 zone for stabilization because historically, that's where forced selling usually burns out. If silver can hold that range for a few sessions without making new lows, that tells me the liquidation pressure is fading. If it breaks below 95 with volume, that's a different story. That means there's more pain to go. Second, I'm watching physical premiums in Asia. If premiums stay above 20%, that historically tells you supply is tight, not broken. That tells you real buyers are still showing up even while paper players are running. If premiums collapse, that's your warning sign that demand is actually cracking. Third, I'm monitoring open interest and volume for signs the weak hands are gone. When you see open interest dropping while price stabilizes, that's usually a sign that leverage is being flushed out. When volume spikes on down days and then dries up, that's capitulation. That's the market running out of sellers. That's when you start getting interested again, not when the headlines are still screaming. Based on my analysis, this move was mechanical, not fundamental. It was structural, not emotional. The underlying reasons people were interested in silver, inflation concerns, currency debasement, supply constraints, those haven't changed in 24 hours. What changed is that too many people got leveraged, got caught, and got forced out. The narrative's the same. The structure just needed to reset. The fundamental picture for silver hasn't deteriorated. Industrial demand is still strong. Solar panel production is still growing. Electric vehicle adoption is still happening. Central banks are still printing. Government debt is still climbing. None of that changed overnight. What changed is sentiment. What changed is positioning. What changed is the price that leveraged speculators were willing to pay before they got their faces ripped off. If history rhymes, and it often does, these are the moments that quietly set up the next leg. Not immediately, maybe not even soon, but eventually. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Talk to dealers. Look at the charts. Make your own decisions based on your own situation, your own risk tolerance, your own timeline. What I'm giving you is a framework for thinking about what happened, not a prescription for what you should do. If you made it this far, you're the type of person who wants to understand instead of just react. That mentality will serve you well, not just in this situation, but in every market you ever touch. The people who win long term are the ones who learn to read structure, who understand mechanics, who separate noise from signal. Share this with someone who needs to hear it. Subscribe if you want more breakdowns like this, and stay ahead of the narrative instead of chasing it. Think critically, verify the data, and make your decisions before the crowd figures out what just happened. Stay sharp out there.